Welcome back to the deep dive. Today we've got our hands on a document that's, well, it reads less like a standard capital raise deck and more like a manifesto, really.
Yeah, it's pretty bold.
We're looking at a pitch from Equity Risk Sciences, or ERS, dated August 2025. And they're basically saying the way we measure stock risk, it's broken, fatally flawed even. And naturally, they think they have the fix.
That's the core of it. Our mission today really is to unpack this claim they're making that they've engineered the first scientifically validated investment risk ratings for stocks.
Big claim.
Huge. And they're not just, selling some software. They're aiming to become America's stock risk rating agency. The goal seems to be nothing less than replacing traditional analysis and becoming the new fiduciary standard.
Wow, okay, a fiduciary standard, that's
Yeah.
ambitious. And they kick things off by painting a pretty grim picture of the current situation, right?
Yeah.
Justifying why this change is needed.
Oh, yeah. They hit hard with the numbers. They argue the current system lets investors lose trillions, even when the market's generally going up.
I saw that figure, it really jumps out. They mention $8.4 trillion just wiped out during that NASDAQ Q slide from late 2021 into late 2022.
Exactly. That kind of number grabs your attention. It's the foundation for their whole argument. Look how much wealth is being destroyed.
It definitely sets a dramatic stage. It's like they're saying, look, the tools you're using now, they don't work when it really counts.
Precisely. It creates this powerful narrative for fiduciaries, essentially saying, you have a duty to protect your clients, but Wall Street's methods, they keep failing spectacularly.
Yeah.
So ERS positions itself as the necessary shield. Data-driven, scientific.
Okay, so before they even get into the nuts and bolts of their solution, they spend some time on the founder, Mullaney. His track record seems pretty central to their credibility push.
Absolutely. It's like, this isn't our first rodeo.
Mm.
They build heavily on his history of, predicting financial storms.
Right. Tell us about that. They go way back, don't they?
They do. They point to 1986. Mullaney's quantitative analysis, this is before data science was even really a term people used widely, apparently predicted the Black Monday crash. The one where the market dropped over 22% in a single day in 87.
And that prediction wasn't just some internal memo, right?
No. It was featured on the front page of the New York Times. That's the kind of validation they lean on heavily. Front page news.
Okay, yeah, that's definitely noteworthy history. But what about more recently? The dot-com boom and bust, the financial crisis.
Good question. The narrative shifts slightly there. It becomes less about pure prediction and more about early warning based on deep analysis. During the dot-com bubble, the deck says Mullaney was sending reports to the SEC.
Yeah, the SEC.
About what? Pointing out major accounting irregularities at companies that were, the darlings of Wall Street back then. Big names like GE and Cisco.
How did that pan out? Because they were giants.
Well, the deck highlights the aftermath. Cisco shares crashed, 72%? Way more than the overall market decline. And GE 10 years later, still down over 60%, even as the S&P had mostly recovered.
Okay, so a pattern is emerging. What about the 2007 crisis, the big one?
Same story, different crisis. Their data science models, they claim, flagged deteriorating financials in high-risk stocks before the market tanked by 50% or more.
So they're using this whole timeline, 87.com, 2007, to say, look, the methods behind our current system have a proven track record of spotting trouble way ahead of time.
Exactly. It's not just history for history's sake. It's proof, they argue, that their system, which they say has been operational since 2013, consistently outperforms by helping investors avoid those huge losses.
Okay, that historical context is definitely persuasive. But avoiding crashes is one thing. How do they actually package this into a product today? What's the elevator pitch, the analogy they use?
They use a really direct comparison to signal their ambition. They basically say, ERS does for stocks what S&P and Moody's did for bonds.
Ah, the bond rating agency analogy.
Right, but they immediately add, but better. They stress independence, objectivity, driven purely by data science, physics, and math. They say not by potential conflicts of interest like sales goals.
Okay, better than Moody's. Got it. So if they're serious about taking on the existing multi-billion-dollar financial data industry, they must have a clear plan. What's their stated mission? You mentioned 3 parts.
Yeah, it's pretty structured. First, engineer these scientifically validated risk ratings. That's the core tech. Second, use those ratings to create fiduciary-grade investment lists. Think approved lists advisors can rely on.
Okay, makes sense. And the third?
Third is building out an institutional-grade research platform. Something that can really compete feature for feature with the big players like Bloomberg and FactSet.
Right, the established giants. Let's zoom in on the ratings themselves, the actual product. They define 2 main ones.
Correct. two key proprietary ratings. First is the loss indicator, or LAA. They position this as the most reliable rating, specifically designed to, well, prevent losses. Pretty clear naming.
LI for loss indicator.
Yep.
And the second.
The second is the Fiduciary Stock Navigator, or FSNR. This one's geared towards capturing profits, identifying the best opportunities.
So LA avoids the bad, FSN finds the good.
That's the idea. Two sides of the fiduciary coin, as they put it. Avoid the downside, capture the upside.
And underpinning both of these is their, what do they call it? The 4D system?
Yep, the four dimensions of risk.
Yeah.
4D, that's their proprietary engine driving the LI and FSN ratings.
4 dimensions. Sounds very scientific. Do they actually say what those dimensions are, or is that the secret sauce?
That's definitely the secret sauce. They don't spell out the four dimensions in the deck. That's the proprietary algorithm. But what they do emphasize is the empirical validation. They show the outputs, the results. And that's where the claims get, well, pretty dramatic.
Okay, let's unpack that validation data then. Because if this 4D system really works as advertised, there should be a stark difference between their top-rated stocks and their bottom-rated ones. What do the numbers actually show?
They claim a really significant statistical separation. Stocks rated A and B, those are their best ratings. Low risk, high opportunity. They apparently delivered gains of 40% or more, almost 3.5 times more often than the stocks rated F, their worst rating.
3.5 times. Can you give me the specific percentages?
Sure. It's 45.9% of the A and B rated stocks hit that 40% plus gain mark, compared to only 13.2% of the F-rated stocks.
Wow. Okay, that's a big difference on the upside. What about the downside, the loss prevention side? Does the pattern hold for avoiding big drops?
It does, and maybe even more dramatically. This speaks directly to their loss indicator claim. The F-rated stocks, the ones flagged with the highest risk warning, suffered losses of 40% or more at over 3.5 times the rate of the A and B stocks.
Over 3.5 times again?
Yeah. The number they give is 62.8%, nearly two-thirds of F-rated stocks crashed by 40% or more. Compare that to just 17.9% for the A and B rated stocks.
So let me get this straight. They're claiming their system shows a roughly 3.5x better chance of big gains and a 3.5x lower chance of big losses if you follow their A, B versus F ratings.
That's the core statistical argument they present based on their historical data.
If that holds up across different market conditions, I mean, that's not just a helpful tool. That's potentially changing the whole game for anyone with fiduciary duty. It's like having a cheat sheet for due diligence.
That's exactly how they position it. The claim is consistent separation of risk and opportunity, regardless of market sentiment, which, leads to the question they implicitly ask you, the listener. If this data is accurate, can you really afford not to use it, especially if you're managing other people's money?
Which logically leads into their big recent case study example.
Yeah.
The regional banking crisis, late 2021 into early 2023. This seems to be where they really contrast their approach with Wall Street's.
Absolutely. It's a perfect storm from their perspective to showcase their system. The facts are pretty stark. 10 major regional banks just imploded, lost around 69% of their value on average, wiped out something like $168 billion in market cap.
A huge financial hit. Now, what was Wall Street saying about these banks before they collapsed?
That's the kicker ERS focuses on. While these banks were heading towards disaster, the major brokerage firms collectively had price targets suggesting these same banks should actually be worth about $253 billion.
Wait, so Wall Street was projecting a gain to $253 billion while they actually collapsed, losing $168 billion.
That's the discrepancy they highlight. Wall Street was overwhelmingly positive, lots of buy and hold ratings.
And ERS, what did their system say about these 10 banks?
According to the deck, their 40-year ratings flag every single one of them, all 10, as F-rated, maximum risk warning. And crucially, they claim this was long before the crisis actually hit the headlines.
All 10 flagged as F. Okay, let's drill down on a few specific examples because that contrast is powerful.
Sure. Take Signature Bank. Raymond James, a respected firm, had it as a strong buy, target price $440. ERS's rating, F. The outcome, total loss, negative 100%.
Ouch. Okay, another one.
Silicon Valley Bank, SVB. Morgan Stanley had an equal weight rating, but the target price was almost unbelievable in hindsight, $985 a share. ERS rating, F. Outcome, again, negative 100%.
A $985 target, while ERS is supposedly flashing maximum risk. That's a staggering difference in analysis.
It really highlights the disconnect they're trying to expose. Or even First Republic JP Morgan rated it overweight with a $250 target. ERS said, no, the actual loss was around 93%.
So ERS uses this banking crisis as prime evidence that their independent data-only approach works, while traditional Wall Street analysis as well may be compromised.
Exactly. They argue their independence is key. No conflicts of interest from underwriting deals or sales commissions potentially influencing ratings. It's purely about the data, they claim. That's why it matters for risk management.
Okay, so they've laid out the history, the product claims, the validation data, and this really pointed case study. Now it comes down to growth. They need funding to scale up, right?
Correct. They're currently doing a $20 million capital raise, looks like a 506c, offering specifically to fund a national expansion.
20 million. And what's the market opportunity they're chasing with that?
Well, the overall pie is huge. The global market for financial data and analytics ratings, pricing, the whole shebang, was apparently over $42 billion in 2023.
42 billion is the TAM, the total addressable market. But what slice are they realistically aiming for? Who are they trying to take share from?
Right. TAM's always massive. They focus on what they call the SOM, serviceable obtainable market. Their target is 5% of the roughly $20 billion market segment currently dominated by the real heavyweights. Bloomberg, FactSet, Morningstar, Zacks, you know the names.
Taking on Bloomberg and FactSet, that's ambitious with $20 million. How do they plan to compete? What's the business model?
It's a SaaS model, software as a service. So recurring revenue, scalable. The plan is to win customers by delivering, in their words, superior data-driven AI solutions. Basically betting that their product's performance will be compelling enough to switch users.
But delivering a superior product isn't always enough against entrenched players with massive networks like Bloomberg. How does that $20 million actually get deployed to make a dent?
They're clear about the allocation. It's going towards expansion, obviously, hiring top-tier talent quants, data scientists, engineers. But a huge chunk is earmarked for national marketing campaigns.
Marketing. To do what exactly? Just build brand awareness.
It seems more strategic than just awareness. The stated goal of these campaigns is to make the ERS-approved stock list the accepted, even expected fiduciary standard.
Wow. So they're not just trying to sell software subscriptions. They're trying to influence industry best practices, maybe even regulatory expectations.
That appears to be the play. They want advisors to feel they have to use the ERS list to meet their fiduciary obligations. It's a bold strategy using marketing to push for standard adoption.
But hang on, isn't that a huge uphill battle? S&P, Moody's, their ratings are embedded in regulations, in investment mandates worldwide. Can $20 million really shift that paradigm? It sounds almost like they need regulatory change as much as market adoption.
That's a fair point, and probably the biggest hurdle. I think they're banking on the power of their performance data. They seem to believe the empirical evidence, if it truly shows the outperformance they claim, will become so undeniable.
That regulators and large institutions will almost be forced to pay attention to mitigate their own liability risk.
That seems to be the gamble. That overwhelming data demonstrating better risk management and returns creates pressure that maybe lobbying dollars alone can't match. It's a bet on the data itself driving change.
Okay, so wrapping this up for you, the listener, ERS is making a very strong case. They claim scientifically validated ratings, a history of accurate calls, stark warnings during the bank crisis, positioning themselves as the essential tool for fiduciaries needing to avoid losses and find better gains.
Yeah, and it really leaves us with a critical thought, a provocative question maybe. The deck presents this specific comparison. Their AAXF model showing a 78.2% return over some period, while the S&P 500 returned just 21.3% in that same time frame.
Nearly 4 times the market return.
Exactly. So the question becomes, can a purely data-driven, truly conflict-free rating system that achieves that kind of claimed outperformance actually displace traditional Wall Street research? And if so, how quickly could that shift happen? That's the multi-billion-dollar question underlying this whole pitch.
78% versus 21%. That's definitely a figure to mull over. A fascinating look into a potential disruption. Thanks for joining us for this deep dive.
Always interesting to see these ambitious plays.
We'll catch you next time.